Okay, so accounts receivable, chapter 8. We already know how we account receivables end up on our books. You know, we sell something on credit or we provide a service on credit. So we already know these basic journal entries. That's not a problem. But what we're doing in chapter 8 with respect to account receivables is we want to make sure that we're conservative and we don't tell the users of the financial statements that we have more money coming in than what we really do. All right, so we have to account for bad debt. All right, and there's really two ways that we're going to look at. So 2 ways to account for bad debt. The first one that we're going to do is called the direct write-off method. And it's a little bit simpler and more straightforward, but it does not, it's not GAAP approved. All right, and the second method that we're going to look at is called an allowance method. Okay, so for the direct write-off method, when you write off an account, okay, so let's say that somebody comes in and this is, let's say it's year 1, and we provide a service for them. So we have an accounts receivable from John Doe and service revenue. Okay, in year 2, we need to write off his account. All right, he hasn't paid us any money. He hasn't shown up. He hasn't emailed us or returned any phone calls or anything. So we decide we want to write off his account. Under the direct write-off method, you write it off directly to bad debt expense. So you would debit bad debt expense and credit the accounts receivable directly. Okay, and that's to write it off, and that's under the direct write-off method. Okay, let's say that he comes back later in year 3, he JD returns and pays his accounts receivable. Okay, so in that case, I'm gonna have 2 entries. I've got to reverse this one because I have to put his accounts receivable back on the books. So I have to reinstate the original entry. So I'm gonna debit accounts receivable and credit bad debt expense. And then I'm gonna record the cash and the accounts receivable. Okay, now the reason this is not approved by GAAP is because when I record the service revenue in year 1, remember that I want to try to match expenses to the revenue that they help to generate. So theoretically, I would want to record the bad debt expense in year 1, but I don't know yet that he's not going to pay me. So under the direct write-off method, I wait until I finally determine that he's not going to pay me, and then I write it off. So notice that I'm recording the revenue in year 1, but I'm recording an expense in year 2. So it's affecting the income statement, and it's not matching the expense to the revenue that it helps to generate. Then down here in year 3, when I reinstate it, I'm crediting an expense, which basically increases net income. So this one transaction is affecting 3 years, when really it should only be affecting year 1, okay? But the direct write-off method is easy to use, and if it's immaterial, for instance, if you don't really have any account receivables, then this method is usually okay. Okay, some places don't. So for instance, HEB in Kingsville, they have very few actual account receivables. And if they do have an account receivable from somebody, it's like the King Ranch or the Armstrong Ranch, and the odds of them not paying are slim to none. All right, so in that case, the direct write-off method would be okay. All right, the other method is the allowance method. All right, the allowance method records the bad debt expense in the year of the actual, when the revenue is earned. So in year 1, we would still have the original sale. All right, we would have a bunch of original sales. So we have accounts receivable and service revenue, or sales, whatever it is. All right, so we have accounts receivable and service revenue. Can't spell, sorry. Then at December 31st, I would make an adjusting entry to record bad debt expense. And I would credit what's called an allowance for bad debt. All right, and this number is estimated. And there's a couple ways to estimate it. You can estimate it based on a percentage of sales or something called the aging of the accounts, where you see how past due accounts are, and the more past due they are, the less likely they're going to pay you. So you figure out what the balance and the allowance needs to be. We're not going to actually do that in class. You're going to be responsible for these journal entries, but you're not going to have to do any of the calculations. Okay, but now the bad debt expense is matched to the revenue, all within the same year. Okay, so in year 2, when you finally write off an account, okay, when you write something off, it's going to come out of this allowance. So you would debit the allowance for bad debt and credit the accounts receivable for that specific person, whether it be, John Doe or whoever. So notice when I did this entry, it has no effect on the income statement. For that matter, it doesn't affect the totals of anything, and we'll talk about that in a minute. All right, then if they come back and pay you, all right, if they return and pay, then you have to reinstate the accounts receivable. So you would reverse this entry. So you would have accounts receivable debited, the allowance credited. All right, for JD, and then the cash and the accounts receivable like normal. Okay, that's called reinstating. This one is reinstating the account. Okay, so let's talk about this allowance, and then we'll be done with this a little bit. So this allowance for bad debt, this is a new account, and this is an adjusting journal entry. So we've got an income statement account. We need a balance sheet account, and that's what this allowance for bad debt is. All right, so the allowance for bad debts is a contra asset account. All right, it has a credit balance, but relates to accounts receivable. So on the balance sheet, we've got assets, and then we have current assets. All right, and now we have cash, and then we typically have accounts receivable. So let's say our cash had 10,000 in it. I don't know. All right, and then we have accounts receivable. Let's say our accounts receivable has a balance of 100,000, and then you would subtract out the allowance. Let's say that it's 5,000, and then the net would come over here to the side. All right, this is our net account receivable. And then you would continue on with the rest of your current assets. Okay, so that's pretty much what you need to know about the direct write-off method and the allowance method.